Hi folks, Rick Wedell here. I'm the Chief Investment Officer at RFG Advisory. Coming to you today on location from a new office that we just opened up in Rochester, New York. Normally we don't do a ton of filming on the road, but given the magnitude of the market move yesterday, we thought we would come to you with a brief market update, kind of let you know what's going on out there. As I mentioned, Tuesday was a very rough day for the S&P 500, the worst day since June of 2020. The S&P was down about 4.3%. And if you're watching any of the local media or CNBC or Fox Business or any one of those other programs, you'll see markets in turmoil on the bottom of the screen and a lot of scary numbers, etc. This is really, once again, one of those times where I really try and encourage people to focus on the absolute level of the index that they're looking at, as opposed to the percentage change on any given basis. Markets are incredibly volatile right now. And so, the S&P 500 is right at 3950, which means, yes, it was down about 4.3% yesterday. But actually, if you look back over the past 7-8 days, it's up a little over 1% over the past 8 days. And the market's actually up 4.5% since the beginning of the quarter, which in any reasonable environment, saying that you had a quarterly positive return in the S&P 500 of over 4.5% would be fantastic news. But when we get these volatile weeks and months and days, you can't let the percentage change volatility really impact your view. It's a lot easier if you just focus in on a particular level and think about, okay, 3950. We came into the month actually in the 3800s. So 3950. We're actually doing. Came into the quarter in the 800s. 3950 is actually not that bad. For performance over the past couple of weeks. What drove yesterday was really an inflation whipsaw. I think last week we were expecting the inflation number to kind of come in around where July's number came in. So back in July, we saw on a month-over-month basis headline inflation at basically zero. And core inflation, which is inflation excluding fuel prices and food prices, come in right at around 0.3% increase month over month, which annualizes to about a 3.5% total inflation rate in the core. And I think that there was some optimism that August was going to display sort of similar metric, which is, declines in fuel prices leading to total inflation that's kind of flat month over month. And core inflation rates that are at that sort of 0.3% or lower, which is really positive news for the market in the sense that it would indicate that we might be closer to the end of stamping out inflation than the beginning. And sadly, that's not the inflation report that we got yesterday. The inflation report that we got showed basically flat total prices driven by energy, but inflation in the core that was running at about 0.6% year over year, which is well higher than what the Fed needs to see to begin to even think about lowering interest rates. And once again, those core prices are things like rental, housing, cost of airline tickets, cellular plans, etc. Really all the services and products that, aren't commodities that don't bounce around much on a daily basis. And it's clear that inflation in those categories is still alive and well, and that the Fed has some work in front of it in order to continue to raise rates and try and slow down the economy a little bit. As a result, it looks pretty certain that we're going to get a 75 basis point rate hike next week. It might be even higher than that, although I think the Fed, one man's opinion, I think the Fed is probably going to stick to its guns on 75 basis points. And it looks like we might have to have a little bit longer, a little bit higher interest rates for longer in order to get inflation under control. I just remind people that while long-term interest rates have adjusted, short-term, is obviously set by the Federal Reserve. And we're still only at about 2.5% on those short-term rates, which is what most people would consider accommodative to the economy. We haven't really moved to neutral or even constrictive interest rates. The Fed is moving gradually. They are taking their time in terms of getting to those constrictive rate levels because they want to move in a measured pace. The goal here is to try and engineer a soft landing, try and stamp out inflation without necessarily causing a recession. That's the hope and the goal, although I think, the experience from the 70s and early 80s would teach us that the Fed, if they have to cause a recession in order to stamp out inflation, then that is what they will do. The markets this morning have been actually fairly resilient after yesterday's sell-off. And I think most people probably would tell you that, both the run-up that we had in the prior week over optimism that maybe, all of this interest rate stuff was behind us, as well as the correction yesterday, are probably a bit overdone. We have a decent amount of time before we're going to see inflation under control, and so interest rates will probably remain high, certainly into 2023. It remains to be seen, when exactly that cooling off period occurs. In the meantime, though, the other thing that I would just say is, the price movement over the past couple of weeks makes it incredibly clear that it is difficult to time this stuff, particularly given the magnitude of the rally that we saw when the market believed that we might be close to the end of this thing. Markets are very, very forward-looking. The second that they get the whiff of good news, they are going to rally strongly to the upside. For those of you who are thinking about maybe I should get out, maybe I should just hold on to cash, etc., just be aware that it is exceptionally difficult to time the bottom, and your re-entry point is just as important as your exit point. So with that, as always, if you have any questions, please feel free to reach out to myself or to your advisor. I hope you're having a great day, and I look forward to talking to you guys again soon.
Thank you for tuning in, and if you're enjoying this content, please don't forget to subscribe and click the bell so you can keep up to date with everything new at RFG. If you want to learn more about who we are and what we do, please visit our website at rfgadvisory.com.